Welcome to the Fear and Greed Daily Interview. I'm Adam Lang. On Mondays, we tend to take a look at different types of investing and get an insight into what the experts are thinking. For many Australians, though, their wealth isn't necessarily in equities or bonds, it's in property, often tied up in the very house that they're living in. And it's a fascinating time in the property market. We've had 2 interest rate hikes and the potential for another one tomorrow. CoreLogic data showed a dip in values in some key markets in May and then another fall last month in June. Tim Lawless is the Research Director for Asia Pacific at CoreLogic. Tim, thanks for joining us again and welcome back to Fear and Greed.
Adam, it's great to be on again. Thanks very much for inviting me in.
Thanks again. So take me through the headline data from the Home Value Index. What happened in our main capital cities last month?
Well, this is the second month where our national index declined. Back in May, it was down 0.1%, and now we've seen a 0.6% drop. So definitely gathering some momentum. But the main story here is still one of Sydney, which is now in its 5th straight month of decline, and clearly that's sharpening. And Melbourne's now down over 5 of the past 7 months, 4 of those consistently down as well. So Sydney was down 1.6% in June, Melbourne down 1.1%, and both those cities, Sydney's down cumulatively now since its peak about 3.1%, and Melbourne by nearly 2%. So still early days, but it does look like this is becoming more of a pronounced downturn and starting to spread out geographically as well. Outside of Sydney and Melbourne, pretty much every other market has lost a lot of momentum. Even a market like Brisbane, which has been one of the standouts, only saw housing values rise by 0.1% in June, so virtually flat. And at this sort of trajectory, we're expecting Brisbane could slip into negative monthly growth by July.
So isn't it interesting when we see these numbers going up, it's a spectacle and it's fun, but how quickly that atmosphere changes when they drop to a minus number. What about the regions? They've also boomed in the last couple of years. What are you seeing there?
Well, the regions are definitely slowing down, but in aggregate at least, we're still seeing some growth there. So our combined regionals index was up 0.1%, so a little bit better than flat, but well down on the growth rates we're seeing, say, 6 to 9 months ago. You know, back then we were seeing the quarterly rate of growth across regional Australia was up around 9%, and now we've seen that quarterly growth rate drop down to 2%. Regional Victoria is the only market that's actually slipped into negative monthly growth territory just now. But yeah, pretty much across the board where we've seen a lot of momentum come out of regional markets as well. So I wouldn't say they're completely insulated from a downturn. I think we'll start to see more downwards pressure on regional prices over the coming months as well.
Yeah, so we've talked about Sydney, Melbourne, Brisbane and regional. I shouldn't sort of leave out some of the other capital cities as well to see if you've got some perspective on those. You know, Hobart, Adelaide, Perth, Darwin, etc. Are you seeing any unique data there?
Yeah, there are some real standouts. If you look at Adelaide as a good example, it's the one capital city that doesn't seem to be slowing down very much at all. We still saw housing values up 1.3% in a month.
That's a lot.
Yeah, it is. It's absolutely a lot. You know, in terms of annual growth in Adelaide, values there are up nearly 26% over the past 12 months. So it's finally Adelaide's had its day in the sun, so to speak, because normally it's quite a steady market. You generally see much more peaks and troughs in markets like Sydney or Melbourne. But Adelaide's definitely benefited from its sheer affordability, its livability, a lot more people basing themselves there and potentially working remotely. But then if you go to the other end of the spectrum, look at somewhere like a Hobart. Hobart was also down slightly over the month. It was down 0.2%. And if you look at some of the underlying dynamics in Hobart, we've actually seen listing numbers in Hobart are up nearly 50% compared to what they were a year ago.
Wow.
And the rate of sale has slowed down really quickly. So we're definitely seeing a lot more stockpiling up in the Hobart marketplace. And finally, buyers are back in the driver's seat, and they've got quite a bit of time to make their decisions and can negotiate a lot harder on their purchase price.
Yeah, and they're coming in. So often we see tiers of different performance in the real estate market, not just by geography, but by classifications such as commercial, residential, and even within houses and units. how did they perform?
Yeah, we don't track the non-residential markets, but anecdotally you can see like industrial is powering along, whereas retail's a little bit harder. But across the different residential sectors, if you look at, say, houses versus units, throughout this pandemic cycle so far, we've seen house values rising a lot more than unit values. Just if you look at the national numbers cumulatively, so since the beginning of COVID back in March of 2020, house values nationally are up about 29%, but unit values are only up about 14%. But that's starting to transition now, particularly in the larger cities like Sydney and Melbourne, we're definitely seeing house values falling faster than unit values now. And that probably just simply reflects the affordability advantage of the medium to high density sector at a time when clearly budgets are becoming much more stretched as housing affordability impacts, but also lenders are becoming much more cautious about lending on, say, high debt to income ratios or higher LVRs, which is probably skewing demand or pushing demand more towards those middle to lower price properties, which of course units really tick the box. So probably seeing a little bit of insulation of demand in that medium to high density sector.
Stay with me, Tim. We'll be back in a minute. My guest this morning is Tim Lawless, Research Director for Asia Pacific at CoreLogic. Now, we talked about the Reserve Bank in the introduction, so we've had 2 interest rate rises now. If we get a third tomorrow, what do you think that might mean for the market? Not just another rate hike, but the compounding effect.
Well, clearly that's another net negative for housing. Interest rates and housing markets have a fairly strong inverse correlation. So higher interest rates, I think, are factored into everybody's decisions at the moment. Well, hopefully that they are, because
that's their intent, right?
I think it's pretty clear that rates are going to be going up consistently for some time. So obviously there's a couple of things that happen there. Importantly, consumer sentiment gets negatively impacted. And we know that sentiment and housing activity are really closely correlated. So higher interest rates generally mean less housing demand, but it also impacts on borrowing capacity and people's ability to actually lend money. So chances are, as we see the rate decision tomorrow, well, I'm in the 50 basis point camp, but there's a lot of people out there that are much better at picking interest rates than me. But it's probably going to be either a 25 or a 50 basis point rise. And obviously through the rest of the months to the end of the year, we'll be seeing even more rate rises. So as we see rates hike even further, then you'd have to expect that this downwards trajectory in housing values will probably become sharper than what it is at the moment. In fact, even if you just look at the data over the last couple of months, I'm looking at my daily index here, and you can see from March 5th, about 15 days after that, you could really see the rate of decline in Sydney and Melbourne became a lot sharper. Prior to that, it was pretty much tracking the trajectory of the 2017 downturn. But now that the last couple of months, it's really separated out and become a lot sharper downwards than what we saw through the previous downturn as rates have risen.
All that data at your fingertips. I'm both jealous and grateful to be speaking with you. So we've seen amongst that data that there's been a spike lately in properties being pulled before auction, and it's been particularly apparent in Sydney. But do you think we'll see more of this shift as in withdrawal from auction towards private treaty sales across the rest of the country this year?
Yeah, I think we will. Auctions work really well when you have a really competitive bidding environment, and that environment clearly losing its effectiveness for auctions. So we're seeing less registered bidders at auctions. As you say, Adam, more auctions are actually being withdrawn. And by withdrawn, I mean they're being pulled from the marketplace without a re-advertised date to go back to auction. Mm-hmm. And probably most of them will pivot back into a private treaty type of sale, or simply just stay off the market. Because that's the other trend we're seeing, is that the flow of new listings coming on the market is also heading south. There's no evidence of homeowners panic selling or stock being dumped on the market or anything like that. In fact, it's the opposite. That the new listings trend is heading lower, but the total listings trend is rising simply because the rate of absorption has slowed down. There's less active buyers out there, which means even though there's less flow of new stock coming to the market, they're not selling anywhere near as quickly, and
It's staying longer on market.
that's exactly right. Yep.
Okay, so this could be a very difficult one to answer, but I'm very interested in your view. Private treaty sales versus auctions and the ultimate price that you get. Do you have a view on which one's the right one? And as you spoke about, I guess, in the last answer, is it really acknowledging where the market's at is the most important thing as to which way you choose to go?
Yeah, it's a hard one to answer, in fact, and I think it really depends on the stage of the market cycle, as well as the type of property itself, as well as the geography. Auctions are really popular in Melbourne, in Sydney, and Canberra. They seem to have a real auction culture, but outside of, look at Perth as an example, less than 5% of properties are taken to auction. It isn't the done thing. But I've found just through my own sort of perspective on the market, auctions tend to work really well when the market's hot, when you have a lot of competition in the marketplace and you have this critical mass of bidders competing against each other in an open format. That's where auctions work really well. And that's probably one of the reasons why I think fewer homes will be taken to auction in a downturn is simply because you don't have that competition that really makes an auction so effective. The other thing about auctions is they tend to be more skewed towards more unique homes where it's really hard for a real estate agent to
gauge a market.
Yeah, that's right. So putting into an auction campaign or even, say, a tender campaign can be really effective if no one's really too sure about what price we can actually get for the property.
There's such big decisions, aren't they, buying a property or selling a property? It really does. This sort of data and getting expert advice really helps.
Oh, absolutely. It's going to be one of the biggest decisions anybody makes, either buying a home or selling a home. It's the same thing because there's so much at stake. You mentioned right at the beginning of the session how much households have in the housing asset class. It's nearly 60% of household wealth is in housing.
Incredible.
Yeah, it's up from about 52% back in the middle of 2019 when the market went through a downturn. So, yeah, definitely a lot vested in this asset class, and it certainly pays to use a professional both from the buying side, as a buyer's agent perhaps, or from the selling side as a real estate agent.
Yeah. So, and you mentioned 2019 and you've got data over a large range of history. Is there a precedent for what you're seeing happening now? And such a tremendous boom followed by this, what seemingly is a correction.
Yeah, there's quite a few precedents actually, and we're looking at the speed of decline here and comparing it back to previous downturns. And there's quite a few instances. I'll just use Sydney as a good example because it's a large market. It's been through 7 or 8 downturns since the mid-1980s. And there's about 4 downturn cycles where the rate of decline was actually faster and sharper than what it is at the moment.
Okay.
Yeah, go back to the early 1980s, sort of 84 to 85. Even during the GFC, 2008 into very early 2009, just before interest rates came down and a lot of stimulus was pumped into the market, Sydney housing prices were falling faster than what they were at the moment. But that was quite short-lived. The market only fell about 3.4% during the GFC and then started to rise again as we saw a lot of that stimulus come through.
Okay. So what about rents? We know they've been rising pretty steeply. Is that going to continue, do you think?
Yeah, that's an understatement. Rents are absolutely surging at the moment. They're up about 9.5% nationally over the past 12 months. And they're not showing any signs of starting to slow down at all. And vacancy rates are typically around 1%, if not lower in some markets. So it looks like rental markets are really being fueled by extraordinarily tight supply levels. And you can probably draw that back to that long period where investment was trending lower between 2015 and 2019. But also the fact that household sizes have become smaller. And that's really amplified rental demand as, say, group households have split up into just couple households or couples, rather than, say, renting out the second bedroom, might be using that as a home office. So smaller household sizes have really amplified rental demand. And now you've got this additional level of demand coming through from overseas migration that's really putting the rental market back on steroids. So we're not expecting rents to come down or the rental growth rate to come down anytime soon. Potentially, we could start to see rental households reforming larger households simply to combat rental affordability, which we know is becoming quite challenging. But that'll be offset by the influx of new migrants, which all that demand tends to funnel straight into rental markets.
Okay. So finally, Tim, census data released last week showed that 1 million properties around the country are sitting unoccupied. Now, that was incredible to me, but it was pretty similar to the previous census. Why are they empty? It might sound very simplistic of me, but with so many vacant properties, you'd think, shouldn't that help with the rental crisis?
You'd think so, wouldn't you? And there's a whole bunch of reasons. I mean, a lot of those will be properties that are used for, say, second homes or holiday homes, quite the luxury, of course. Other properties might be owned by homeowners who might be overseas, particularly on census night, or could be foreign investments who simply choose not to occupy their home and often have to pay a vacancy tax on top of that as well. So for whatever reason, even if you weren't home on census night, then potentially that's counted as unoccupied as well. But it's a great point to make, because if all those unoccupied dwellings were pumped back into rental markets or able to be rented out, it would definitely go a long way towards solving this rental crisis that we're in at the moment.
Tim, it's always a pleasure. So thank you very much for talking to Fear and Greed.
Thanks, Adam. It's great to be here.
That was Tim Lawless, Research Director for Asia Pacific at CoreLogic. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Adam Lang. Enjoy your day.